did Mihir use the word gorilla? And here's an interesting graphic which would come on your screen, which is that in investment terminology, when you look at gorilla, well, what are gorillas? Gorillas are rare. You rarely find a gorilla in a jungle. They are dominant and they live long, unlike the monkey tribe. Now, good companies are rare to find. There are very few companies which will survive the ups and downs of disruption and market volatility and macro uncertainty. And if they live long, they can create a lot of wealth. So that is the underlying thesis behind gorilla investing.
Absolutely.
Okay, so let's understand first, why are good companies hard to find? Because if India opportunity is so great, everybody should do well.
Absolutely. So that's a very pertinent question, and gorilla investing actually is kind of a personification of our investment style, which is to find stocks with high terminal value. We call it terminal value investing.
What is terminal value?
Exactly. So, normally in markets like India is anyway a high growth market. We grow GDP at 6-7%, so nominal GDP grows at 11-12%, right? And within that, the corporate sector, the organized sector is growing faster, so say 12-13-14%. But even within that, there are always segments and sub-segments which grow much faster than even 12-15%, right? What is typically happening, and this is a mental thing that all analysts and fund managers have, that it's easier to predict for the short term. So we look at the past few years of track record or good growth. We meet the company, we know the company's business plans for the next few years, and it's easier to predict or at least forecast some numbers for the next 2, 3, 4, 5 years. Typically beyond 10 years, nobody forecasts. So in high growth stocks and sectors, what happens is you would predict 30-40% growth for the next 2-3 years. Then you're not sure, so you taper it down to 25%, then maybe 20%, 15%. And beyond the 10th year, it's just not visible. So you just say that it'll grow at say GDP levels. So typically,
like IT, 2000 growth 100%.
Absolutely.
Came down to 50.
Absolutely.
When they spoke about 30% growth, it was called as a profit warning. And today they are growing at a rate which is lower than India's GDP.
Absolutely.
Nominal GDP.
Nominal, absolutely. So that's what typically happens. That's the mindset, that the further you go, the less clear it becomes. And then, so you assume conservative numbers, say 5-7% GDP growth, that kind of numbers. What happens in high growth stocks and segments is that this growth rate beyond the 10th year that you're assuming does not end at 7%. It stays high, or even in some cases even accelerates. Okay. So the value,
just for academic purposes, can you enumerate that with an example? We're discussing not a stock recommendation here,
absolutely,
but perhaps an idea which can just go well with the audience.
Absolutely. So let's say the largest jewelry company in the country, promoted by the most respected business house, which was into watches earlier, and in the 90s they diversified into jewelry manufacturing.
The company which is known as RJ's famous stock.
Yeah. Okay. So this company in 2006, because we have data, we have done a lot of studies since 2006. In 2006, this company had a profit of approximately 80 crores, right? And the market cap was approximately, give or take, 4,000 crores. At that time also, it had already become a high growth company. So it was growing at 20, 30, 35%. So it was a 80 crore profit company, 4,000 crore market cap, and growing at a fast pace. So typically, what the framework that we use, we would assume a few more good years of 30-35% growth, then 20-25% growth, then 10-15% growth, and beyond 10th year, let's say 7%, which is kind of like GDP growth. So by that logic, today, the profits of that company should have been approximately 1,300 crores, right? Today, for FY24, the profits of that company are probably closer to 4,000 crores, right? So our model was so conservative that we got today's profits wrong by almost 3 times. It's even more stark in the market cap sense. Remember, I told you the market cap was approximately 4,000 crores and the profits were approximately 80 crores. So at that time, the PE was 50, right? Today, I told you the profits are closer to 4,000 crores.
Yes.
So effectively, the PE was 1, not 50, right? Because the profits went up by 50 times.
So you will only buy stocks in this mutual fund or in this scheme which you can hold for 10 years. Is that what you're indicating?
No, that's where the biggest misunderstanding happens.
Okay.
It's that, as I told you, you would have thought in 2006 the PE is 50.
Okay.
Even I would have thought the same, because we did not have the vision of 4,000 crores profits. Which means that we would probably have not bought the stock because we would have found it expensive.
Okay.
Right? But if somebody had a view that this stock is in a blank sheet in the largest consumer segment, which is jewelry in the country, with a brand name like the sponsors, and virtually no competition in the branded space at that point in time. Even now, 80% is still unorganized. Then, if one would have taken some vision and predicted some kind of a profit, even if you are wrong by 100%, it still would have been a huge pathway. So that's where the difference is. So the stock made money in the first 10 years, which is the projected period, but it continued to compound even after that. So the CAGR for the stock from 2006 to 16 was 8x, almost a 23% CAGR. But from 16 to 23, it again grew by another 7.5 times.
Wow.
So it became a 60 bagger. So first of all, by having that bigger terminal growth rate in mind, you would have actually ended up buying a stock instead of ignoring it and treating it as an expensive stock.
So if I break it for our viewers,
and you would have held on to it because you're not buying it for 100% gains or 200% gains, because you still have a view about the long-term growth rate.
So just to break it for our viewers, what you're saying is that you are in the quest of identifying that how high the peak of a mountain is. When you're the bottom of the mountain, you cannot see the peak. It could be clouded, it could be snowy.
Absolutely.
You don't know how high the peak is, but
Absolutely.
you're trying to understand that how strong the runway, pathway or the peak is. That is terminal value investing.
Absolutely.
At the current juncture,
If you like this video, then like, share and subscribe to ET Now.